There is already a huge amount of bad news priced into this sector. I mean, Stellantis has already lost 40% there.
The German car maker is also considering closing car plants in Germany.
Volkswagen is closing factories. Analysts do not see the situation well. Europe is lagging behind in the electrification of the automotive industry. EU car companies are trading at record lows. China is crushing the competition. Tesla is capable of dropping in one day by an amount equal to the total market capitalization of Volkswagen. Where the most interesting opportunities are now in the automotive sector, what stocks are definitely worth your attention, and how this situation can affect the value of your portfolios, we'll look at today. Hi investors, this is Chris from 𝗕𝗂𝗶𝗀. None of the information in this video is investment recommendation. Always do your own detailed analysis. European automakers are facing a number of challenges that are impacting their market valuations. Companies like BMW, Mercedes-Benz AG, Porsche, Stellantis, Renault, and Volkswagen are either at or very close to record lows. You can easily compare these automakers using Octagon on 𝗕𝗂𝗶𝗀. You can quickly see which company is doing better compared to its competitors. Weakening demand in key markets, especially China, and intensifying competition in electric vehicles are eroding investor confidence and raising concerns about the future of the sector. This decline in valuations is not unique to BMW. 5 of Europe's 6 major car makers have seen their share prices fall in 2023, with Stellantis and BMW the hardest hit, both losing more than 30% of their market value. It is an alarming trend that shows that no one is exempt from problems. On the other hand, there is one exception: Renault. This has seen a slight increase of 3% since the beginning of the year, although its valuation remains weak, which is in line with the overall state of the sector. This suggests that even in difficult times there are manufacturers trying to find a way to appeal to the market, but the overall picture is still rather pessimistic. Porsche AG, despite being one of the few companies to maintain a double-digit price-to-earnings ratio, still remains below its historical average. This fact is indicative of the general uncertainty in the market and the lack of investor confidence. Another major manufacturer, Volkswagen, recently cut production in Germany, the first time it has closed factories in that country since 1938. Today, its shares are trading at just 3 times expected earnings, the lowest in its history. The move is a clear signal that car makers are facing unprecedented challenges that are forcing them to rethink their strategies. Overall, the combined market value of Europe's 6 largest automakers is about 260 billion euros, less than half of Tesla's market value. This difference is shocking and highlights how the car market in Europe is evolving. If you want to know not only the fair price of European car makers and be at the heart of the stock market, become a member of 𝗕𝗂𝗶𝗀𝗃. Plus, you get detailed stock analysis, news on portfolio companies, or a portfolio P-tracker with dividend calendar. According to George Galliers, an analyst at Goldman Sachs, August sales in key markets such as France, Germany, Italy, and Spain recorded double-digit year-on-year declines after adjusting for selling days. We believe visibility remains low due to political and macroeconomic uncertainties. Sales of battery electric vehicles remained under pressure and posted large declines, Galliers wrote. Dr. Cyrus de la Rubia, chief economist at Hamburg Commercial Bank, highlighted the key factors affecting German car manufacturers. According to him, the most significant factor is the increasing loss of global market share by German car and machinery manufacturers to competitors in China. Unfortunately, this problem is here to stay, warns de la Rubia, suggesting that competition will not be a passing phenomenon, but a long-term challenge. Another alarming sign is the latest global EV tracker from Bank of America, which shows that all European car makers have seen a decline in EV market share by 2024. This trend is particularly worrying as EVs become an increasingly important part of the automotive industry and the future of mobility. For example, Stellantis' market share fell from 4.0% a year ago to 2.7% in July, a dramatic drop. According to the fair price on 𝗕𝗂𝗶𝗀𝗃, the price is already well below its intrinsic value. Volkswagen, which has recently been trying to upgrade its electric vehicle offerings, has fallen to 6.6% from 7.5%, while Mercedes-Benz has fallen to just 1.9%. These figures clearly show that European car makers are facing huge competition from Chinese manufacturers and other global players who have jumped on the new electrification trend with alacrity. One of the most significant challenges facing the European automotive industry is the high cost of producing electric vehicles compared to traditional combustion engine vehicles. Although EVs have lower running costs, their initial purchase price remains around 20% higher than their internal combustion counterparts in key markets such as Germany and France. This is despite government subsidies to encourage consumers to switch to EVs. These higher costs, coupled with rapid technological advances in EVs, have led to faster depreciation of older EV models. This means that their value in the market is declining faster, which is discouraging many potential customers from switching to EVs. This factor thus continues to hinder the wider adoption of EVs. At the same time, the European car industry has to deal with macroeconomic uncertainties and fierce competition from Asia, especially China. In addition, the companies are paying a very solid dividend indeed, thanks to the significant decline the stock is going through right now. The payouts are approaching 10%, which is very respectable. Now let's look at how can European companies get out of this. Here are a couple of points that are key for them right now. 1. Focusing on cost reduction and production efficiency. Car manufacturers should invest in innovation and technology that will enable them to reduce the production costs of electric vehicles. This includes optimizing production processes, finding cheaper and more sustainable materials, and automating production. Switching to platforms designed specifically for EVs could also make production more efficient and reduce costs. 2. Accelerating the development of cheaper EVs. One of the main problems with EVs is their higher purchase price. Automakers should focus on developing more affordable models that have broader market appeal. Creating smaller, more fuel-efficient models with longer battery life could attract consumers looking for an affordable alternative to traditional internal combustion engine cars. 3. Cooperation with technology and software companies. Technology and software play a key role in electric vehicles. Working with technology companies to develop better batteries, autonomous driving systems, or improved infotainment systems can give car makers a competitive advantage. The development of advanced software platforms and connected services can also add value to customers and create new revenue channels. This is an area where Tesla absolutely dominates the market. 4. Agile response to trends and rapidly changing demand. Automakers should engage with governments and energy companies to improve EV infrastructure, especially expanding the charging station network. Accessible and easy-to-use infrastructure is one of the key factors for increasing demand for EVs. Good luck with your investments.